The major indices bouncing back from yesterday's sell-off, the Dow closing higher for the first time in 6 sessions. But volatility remains, particularly in the highly speculative trades, including GameStop, AMC, American Airlines. Our next guest wants no part of the craze. He's waiting for the next major market pullback to add money into stocks. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, good to see you.
Great to see you, Mel.
You said that in the notes that I have that we're seeing the dynamic play out in terms of the short-term impact on the market of this Reddit army, but that the long-term market fundamentals are intact. Does that mean that you believe this goes away?
So, Mel, I was thinking about this in the context of, have we ever had a 60% rally off of a major bear market, economically based March low? And did you start that next year after that 60% rally off that March low up 3%? And then you had some kind of flash crash, some kind of market structure fear come into play. And of course, that was 2010. And as you know, from some of the written stuff we've talked about, we were tracking from the summertime of last year, we were tracking what took place in the fall of 2009. You stair-stepped higher into new highs. You opened up 2010 with a 3% gain, and just out of nowhere, out of euphoria and a lot of excitement, you just had a series of corrections. You had an 8%er in the first couple of weeks of February, and then a 15%er with the flash crash, speaking to Dan's point about how the MF Global created ripples in the market. The flash crash created ripples in the market. It was the beginning of a correction. So I am so excited about the intermediate to long-term prospects of excess liquidity, truly historic excess liquidity, coupled with a synchronized global recovery. But we need a little bit of the air to come out of the balloon here.
I see what you're saying, Tony, totally. But I do want to get your thoughts about what is happening with the market dynamics when it comes to this group of investors who have exerted themselves and forced hedge funds to change the way they trade, at least temporarily. Do you think it's a temporary blip? And do you think that there are longer-term implications to the markets?
Mel, Brian Sullivan had a great interview with Chris Murphy from Susquehanna yesterday, who talked about the open interest in options. And this is my personal opinion. You know me long enough. We're a team. I'm a data guy. I go by data, but here's the first non-data comment I'll have in a while. I think the idea that very small option traders are making all of this happen is like believing that somebody in a Viking helmet organized the Capitol riot. I think that there is real money behind both sides of this trade. And of course, it is affecting on both sides the small investor. But when everybody else is in chaos, I think the strength that I have is to sit back, have a little bit of perspective, and ultimately determine what really drives the market and the economy. And that's availability of money. And we have a historic level of availability of money. The time to get worried, as you know, because remember, Mel, the Dwyer doomsday clock from last fall, August 26th, when the yield curve inverted? Well, it's the opposite now. You're coming out of the recession. You have an extraordinary amount of stimulus from fiscal, monetary, and interest expense savings.
And so, sorry, Tim was going to jump in, but I think he's frozen, Tony. So I'll just go ahead and jump in. So, okay. I mean, I don't want to force words into your mouth, but it almost sounds like Jerome Powell is at the heart of what is going on in the markets today, including what is going on with GameStop.
100, Mel. It's extraordinary. The guy keeps looking into the camera. How many times have you and I been on set? I wish we were on set again. How many times has Jerome Powell looked into the camera, giving you the game plan, and geniuses like me trying to figure out if it's right or wrong? The guy told you what he's doing. We're at 1.4% core PCE. The vice chair of the Fed, Clarita, said they wanted above 2% for a year. Now, I'm not a mathematician, but 1.4% is below 2% now. You got to get to 2% before you're there for a year. You've got an extraordinary amount. See, what people miss, Mel, is the stimulative effect of interest rate reduction. We talk about inflation. We talk about price power, and all this money is going to print inflation. Yes, but interest expenses collapse for the government, for corporations, and for households.
Tony, I wish I did see you. I can't see you because I don't have a return, as they say in the business. But my question is exactly that. The Fed wants inflation above 2% for a year, but embedded in that is the fact that they somehow think they can control it. Let's just play the what-if game, and I'm a big believer that you're going to get inflation in spades in the back half of this year. What if instead of around 2% for a year, it goes from 1.4 to, let's say, 3.25, 3.5 in the course of 6 months? Then they're totally behind the eight ball, and that's not something the market is expecting.
Well, Guy, I think that will, of course, create some indigestion if that happens. But honestly, I think inflation is going to pick up pretty dramatically. You're going to remember, inflation is a year-over-year number. So you're going to bring in the March, April, and May of 2020 numbers. So you're going to have inflation from those price drops back then. But then after the summertime, you're going to be anniversarying the big jump up in inflation that came with the stimulus June, July, and August. So again, I think settle back, treat it and look at does it shut down money? The guy printing it keeps telling you he's not shutting it down. Pricing power for companies is a good thing.
Right.
That's why earnings surprise to the upside, I think.
Tony, thanks so much. Good to see you. Tony Dwyer, Canaccord Genuity. His playbook includes a lot of the reopening trades, small cap cyclicals, emerging markets. James, what do you think of that playbook?
I think it's a great playbook once we settle on what this sentiment is going to do in the short term. I agree with everything Tony said. And, the problem right here is that we keep going higher in different pockets. The market somewhat cooled off here earlier this week, but we've seen a resurgence of energy around these names. It's the Reddit situation. The January daily options is 4 times as normal. That's not sustainable. And so I think we will go back to some type of bullish market in pockets. Obviously, e-commerce is going to do well. Obviously, 5G is going to do well. Clean energy is going to do well. Back to U.S. Steel's outlook, we're looking at, infrastructure play perhaps to buttress the economy going forward. So there's always going to be pockets of strength. And I do agree with what Tony's pointing out in terms of, there's got to be a pullback here, at least in the short term temporarily before we continue to take our optimism forward.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.